Welcome to my next video, and we're going to be taking off where we talked about the US bond market. What I specifically want to talk about today is the European bonds, and especially sovereign bonds, because it's extremely important. Now, Europe has been like the United States. It's had a major liquidity crisis, credit crisis, and that was in 2011. So it was somewhat later than the US crisis, but nonetheless it was just as deep. Basically what the Europeans did is they also went down the quantitative easing side of things and copied the American model or the Japanese model originally, but the quantitative easing model was copied in Europe. Now, whereas in the United States we call government bonds treasury bonds, in Europe, because it's a united currency zone as far as the euro is concerned, they have what's called an ECB, a European Central Bank, and this central bank issues bonds which are called sovereign bonds, equivalent to US Treasuries, on behalf of the countries that are members of the Eurozone. Now, one thing to point out, that sovereign bonds are they're not homogeneous like the US Treasury bonds, because you have Greek bonds, German bonds, Irish bonds, Italian bonds, Spanish bonds, you get the picture. Now, whereas United States Treasury bonds are homogeneous in the fact that it deals with a complete market, and if there's a rate, like say for example today's rate at 3.25% for 10-year bonds, you know that that's the rate, but that isn't the case with Europe. Europe is basically like a whole load of United States of the US. So you have got different rates for European bonds, for German bonds, Italian bonds, Spanish bonds, Greek bonds. And we've seen during the crisis, especially the crisis in 2011, how these differentials in yields were quite marked. And there was effectively what I would call a two-tier market. Now, why is this important? This is important because if bonds aren't all priced equally, that means that there's a differential in risk that's attached per country. Like, for example, ask yourself the question, are Greek bonds more secure than German bonds? Well, if you're a rational person, that you'd say German bonds are more secure than Greek bonds, and therefore you would expect to pay a lesser premium, and that's the case. So it sort of defines logic that you have a euro, but yet you've got these different bond prices, and herein lies a major problem, because when one country like Greece has got a hiccup or had a hiccup, then it affected the whole sovereign bond market. And what's extremely important in this is that the balance sheets of banks, according to the Bank of International Settlements, they have weighted sovereign bonds with zero risk. That means that Greek bonds trading currently around the 5% level at the moment, Italian bonds around the 4% level at the moment, have got a zero risk weighting in the balance sheets of banks. So, in other words, because of the Dodd-Frank legislation, because of the Bank of International Settlements and the result of the last Great Recession, balance sheets had to be restored. So what's happened is that US banks in particular have loaded themselves up with European sovereign bonds because they are zero weighted risk. Now this poses a problem because the portfolios within the banks themselves can be subject to sovereign risk shocks. For example, what happened in Europe and what happened with the Greek fiasco. Now let's look at today's situation where the Italian economy is looking really, and especially the bond market is looking really fragile at the moment. There are a lot of bonds that are in the system, and this is quite a particular worry as far as the US banks are concerned. Now, Europe's quantitative easing, in my view, is a ticking time bomb. And why is it a ticking time bomb? It's because, as I said in the previous videos, debt is a major problem for the world economy, and we have several sources of debt that are of a concern. We have the US debt, we have the European debt, we have the Chinese debt, we have the Japanese debt. And when we combine all those, it's quite horrendous. So we're now looking at the European debt. Now, the European Central Bank has actually issued more bonds than the United States. we're looking, now the United States, somewhere around the 2.4 trillion, maximum was around the $2.4 trillion level. Europe has issued close to $3 trillion. And what has the European Union got in terms of growth? Pretty well nothing. Now, one of the risky parts of the ECB, as far as I'm concerned, is where these investments, where these bonds have gone. So basically the way the process is, the ECB prints bonds, the bonds then are given to the banks then produce the money, and the banks then lend the money out. Well, that would be good if it worked in principle, but a lot of the banks, just like the United States, have held on to the bonds. What the European government or what the European Union has done is that they have allowed bond purchases to be done in favour of buying corporate bonds. And what this has basically meant is that companies that normally wouldn't necessarily go to the bond market, because a lot of European companies are fairly well run, like American companies, they've gone and they've got 0% interest rates bonds. And what this has meant is that it's subsidizing the profit-making enterprise for capital coming in by way of bonds, because it's costing zero. So there is a long-term effect of the productive capacity of many of these European companies that they're actually becoming less efficient because, hey, they've got money for nothing, literally money for nothing. So this is creating what we call zombie companies. These are companies that under very lax economic conditions, when I say lax economic conditions, I mean very easy credit. Because just like America, I mean, if you're paying 0% interest, you're going to take as much money as you can. So what the ECB has been doing has been gobbling up bonds. And if we look at the rate of it, over the past 3 years, 3 years since 2015, in this particular slide here, we can see that the ECB has been printing bonds to the tune of $60 to $80 billion a month. And of this, 17% on average, between first quarter of 2015 to the beginning of this particular year in 2018 was around 17 to 20% going into corporate bonds. Now, this year there's been a large appetite for corporate bonds, and with the ECB pretty close to 40%. So what does this mean? It means out of $3 trillion that have been raised, close to $800 billion has been given to these zombie companies. And you may have read about a year ago there was a particular company that looks like it's going under, Steinhoff, or has gone under, and it received quite a few billions, or quite a lot of money from the sovereign bond fund. So this is an example that the companies that are getting these bonds in Europe are not necessarily the fittest in a properly functioning capital market to raise the finance. And this is a major concern, because we're seeing at the moment that the United States has is starting to do an aggressive taper of the actual bond purchases. Mr. Draghi has said that towards the end of this year, no more QE from the European Central Bank. So this means that companies that have now got used to 0% interest money are now going to be in a position where they've got to increase their profits. But can they do that? Some of them are going to fail. And that's a bit of a concern. So we're now starting to look at these government bonds with zero risk have been given to companies, basically subsidizing the corporate risk and therefore distorting the market in total. That's going to end in disaster. I mean, just imagine half of that, 400 billion, going down. Well, it's almost a Lehman event, and that's just in one bond market, the euro bond market. So this is something that we've got to really be concerned about. Now, this next slide, very interesting. We can see that you can see that the amount of bonds that governments are holding has skyrocketed. I mean, we're talking about less than 5% 3 years ago to 15 to 18%. We're talking about Denmark, Spain, Netherlands, Germany. I mean, we're looking close to the bond holdings, sovereign bond holdings of these countries are close to 20%, and it's exploded. And this money has to be paid back. It's got to come out of the treasuries of these particular countries. And what's going to happen when we go into a recession, deep depression, whether it's caused here by Europe or caused somewhere else in the world by China, or perhaps there's a major slowdown in the United States? This money has to come from the taxation base of the Eurozone. Now, many countries like Greece, Ireland, Portugal, Spain, the PIIGS countries, and even Italy can't pay, won't pay Italy. Germany is going to have to foot the bill, and I don't think the Germans are going to want to foot this bill. So the American banks that are sitting in sovereign debt from Portugal, Greece, Ireland, Italy are going to be in a situation where there's no creditor of last resort. And this is an extremely, extremely dangerous situation to be in. Now, you're saying, but sovereign bonds, I mean, they're like the US Treasury bonds, nobody's ever going to default on these things. Well, think again. Think again. Greece, small economy, 10 million people, a GDP of about 195 billion. So not small, but not big. 2 years ago, the country has been, since the 2011-2012 crisis, the country has not been able to make ends meet. It's had 2 bailouts, the last one 2 years ago. The problem with that was that because the IMF basically said, you're going to have to cut taxes, you're going to have to go back to complete austerity, and as a result, the IMF and the ECB and the Greek government decided, okay, our citizens, the Greek citizens, are going to be limited to 60 euros a day. As I said in the previous video, I say, well, can you live much on 60 euros a day? Yeah, you might say you can, but what if you've got to pay your mortgage, your fuel? The cost of living in Europe is quite high. In Greece, it might be lower than other places, but just imagine if this was $60 a day. Could you live on $60 a day with a family of 4? It'd be, I would think it would be very hard, because that's $1,800 a month. So that's not a lot of money. So when you think about it like this, you're looking at really large disparities in terms of the risk. Now, something of very great interest as well, as far as the possibility of a real default, is that last year when growth was strong in the United States, averaging about 4% according to government figures, growth in the Eurozone was 2.25%. But interestingly, 3/4 of that growth has been due to the sovereign bond issuance of the ECB. And that's like Bloomberg, MarketWatch, Morgan Chase research. They've basically all said this, and so it's not something that's pulled out of the cloud, basically. So what this means is, if it's 0.75%, real growth in the Eurozone from productive capacity was at 1.5%. So there's not much flesh on the bone. Now that means that countries, the PIIGS countries like Spain, Italy, and in particular Italy, and that's one to watch, and that's going to be the subject of another series of videos, are going to be in a position that can't pay, won't pay. And I wrote a book just 2 years ago, Too Big to Rescue, and we're going to have 5 major crises that all coalesce. And I did say that Italy was going to be a problem 2 years ago, and I did say that we're going to go to the situation in Italy where they're going to say can't pay, won't pay. Now, it's not the size of the Greek economy. This is a major, major European economy with about 2 trillion in debt, external debt. So what does this mean? This means a complete financial credit crunch. And not only that, the banks in Italy, well, yeah, they need at least 500 billion just to keep them liquid from non-performing loans. So Europe's sovereign bonds are not at all priced properly. This is something that really, really, really concerns me, because, again, it comes back to this liquidity side of things, that if the United States may be chugging along really well, but if it gets an economic shock from Europe and banks are affected and we don't know where the credit side of things go, this is something that you really do have to look out for. So what we're going to do is, in the next video, we're going to look at the more individual statistics in some of these PIIGS countries, because I am very concerned, for example, about Italy and Spain, because they're large economies, and the ability of Germany, because Germany I see as a lender of last resort, their willingness or non-willingness to fork up money. And let's face it, if Germany won't do it, will the United States? So please watch for the next video, because we're going to go into more detail about what this crisis really means in an individual sovereign risk basis. Thank you so much for watching the video, and I'll see you in the next one. Bye for now.